David, thank you so much for coming back on.
Thanks, man. It's a pleasure to be back on your show.
Absolutely. So we were talking a bit offline about how your first fund, I believe, BTGD,
Yeah.
how given Bitcoin's drop, it's really outperforming. I mean, it's down a little bit, but not much.
Yeah, we're one of the top performing crypto ETFs in Morningstar's category, albeit even with being a leverage ETF that's both 100% exposure to Bitcoin and 100% exposure to gold, ticker BTGD. The concept there is to offer a more institutionalized version of a leverage ETF that is eligible to be bought and held and not just traded. Obviously, you can use these vehicles as trading vehicles as well. The commonality between Bitcoin and gold is scarcity and currency debasement and monetary debasement, and finding things that just have some sort of supply constraint, of which both Bitcoin and gold both have. And honestly, since launched the fund, Bitcoin and gold have kind of taken turns in their performance. We launched 3 weeks before the election in 2024, in October 2024. And at first it was all Bitcoin, and then we were heading into Liberation Day, and Bitcoin was falling, and it was all gold, and then again it was all Bitcoin, and then in the fall it was all gold again, and taking advantages of those swings, making the difficult rebalances to get back to par, to get back to 100 and 100, really does add a lot of value. And the concept really here is, adding the return to Bitcoin plus the return to gold, minus a very cost-effective form of financing, but not necessarily adding the risk of Bitcoin plus the risk of gold. If you look at the volatility of BTGD, it's much less than if you had just held Bitcoin and gold and didn't rebalance. And it sounds so simple, but rebalancing is one of the only free lunches we have in the investment world today. So taking advantage of that benefit of the somewhat uncorrelated nature between Bitcoin and gold. Obviously, last week we saw a bit of correlation between the two. Really, really helps over time, and allows this leverage vehicle that you can hold for the long run. My favorite way to describe it is addition without subtraction. I think a lot of young investors see the validity in an asset class such as gold, but worry that it might actually be a drag in the portfolio. And what does that mean? That means it might actually be slightly worse performing than your benchmark. Your benchmark might be, for example, the S&P 500. And when you're adding when you're adding gold on top of Bitcoin in a stacked product, you're no longer benchmarking versus, for example, the S&P 500. It just has to outpace the cost of financing to be added into your portfolio. And so it's a way to add gold to your portfolio without really taking away from the beta. And then we're very excited to announce that we're on week 3 of our income stacked lineup. So BTGD was our first stacked fund, and now we have 2 income stacked funds, ISSB and ISBG. The I and the S stand for income stacked. So it's income stacked stocks and Bitcoin, and income stacked Bitcoin and gold. You are correct if you assume that ISBG will perform very similarly to BTGD, albeit potentially even a little bit of further upside, because we're also harvesting the volatility on both Bitcoin and gold. And there's many different ways to do the income world and the income products. How we really focused on the construction of these is to be risk managers first. There seems to be 2 camps. There's some managers that just sell calls and kind of wait the month out, wait the quarter out, and see what happens. We call those a little bit more strike sellers than risk managers. And then there's certain
Yeah.
managers that target an exposure. And we will have up to 10 rebalancing periods a day in the income stack lineup. Sorry, 10 rebalancing periods a week in the income stack lineup. We won't always rebalance 10 times a week, but we can rebalance up to 10 times a week in order to hit that target of 1+1. So you'll actively see us roll over our calls and not just kind of sit on a single strike. And we feel that the value creation that we're adding is really in how we construct that Delta 1, that Beta 1 product in each leg. And, we'll have an in the money call option for most of our beta. We'll sell a call, and then we'll occasionally sell a put. And the call that we sell won't be on 100% of the notional. It can range from 25 to 75% of the notional. We really want this to be, a growth and income vehicle within that income space. And the put that we may sell will be, between 0 and 33% of the portfolio. Sometimes we'll have no put in the portfolio, and sometimes, again, we'll sell a put for up to a third of the portfolio. And the basic beta that we get from that slightly in the money call is great because it has a little bit of an embedded put. So if we have a call that's 10 to 20% in the money, a long call is the same thing as long stock and long put, right? So we have an embedded put in there, which means, if you look like a week like last week when an asset class is falling drastically on a single day like Bitcoin, we actually have a little bit of breaks already built into the fund. And then where the active management comes in is like how we respond to that. Like, and I think last Thursday is very telling. We also now have our daily stock trades posted to our website. So I know on the Income World, you guys really like to focus on what were the actual trades in the fund. So that's now available on the website. But
Nice.
I think how we responded to Thursday last week was very, very telling to what you can expect from us. And I'm very proud of how we responded to 30's drawdown in both Bitcoin and gold. And what we did was we lowered the tenor of our positions. And then we also sold more puts on Bitcoin. And so what does that mean, lowering the tenor? So we took our in the money call option. We had a much further dated option, and we shortened the time frame on that. And we also added some puts. It still means, the morning of, we had 100% exposure to Bitcoin. The afternoon of, we still had 100% exposure to Bitcoin. Friday, still had 100% exposure to Bitcoin. But the added value is moving those tenors, which harvested the volatility. Volatility spiked so much in Bitcoin, and the price of volatility in Bitcoin spiked so high. So our active bet that day was that, we're not going to directionally bet on Bitcoin here, but we're going to bet that the volatility spike is higher than it should be and sell some of the vol that we had protection embedded into the fund already. And, this is true institutional hedge fund like offering in an ETF wrapper. Last ramble I'll add here is that the beta that we're getting, that long call option in the money, is a flex option. So we're able to roll that over without incurring capital gains. And quite frankly, this is just things that individual investors don't have access to in their own accounts. So it's institutionalized leverage, it's unemotional rebalancing, and it's taking full advantage of the tax benefits that are available to us in the ETF wrapper.
Awesome. And so these just launched, like I think one was what, January 21st?
They both were seeded on January 20th and then launched on the morning of the 21st. Yeah.
Nice. Yeah. Yeah, I see because Thursday was like one of the like biggest drops in the market I've seen in a while. So that's amazing that you guys like really came right back from it.
Yeah, I mean, I think the important part here is whether it's on the downside or upside, we're keeping that 100% exposure. We do have some breaks built into the downside. So if you chart, for example, ISBG versus BTGD, you'll see those breaks actually came into play a little bit on Thursday, and we actually lost a little bit less
Mhm.
on that drawdown on Thursday. But unlike some of our competitors, we're going to actively move our targets to make sure we have that 100% exposure and have a Delta One product or Beta One product on both legs of the funds, whether it's stocks and Bitcoin or Bitcoin and gold. And this is the first two of a whole series of lineup that we will intend to come out with in the future. We have stocks and gold, treasuries and gold, treasuries and Bitcoin, and stocks and treasuries also in the hopper as well to complete this whole income stack lineup. But the idea is to take your broad asset exposures and give you institutionalized leverage with this weekly dividend paying concept behind it as well. And we're also, I think the two main messages we're trying to push here is risk management over strike sellers. Don't just throw a dart at an options chain once a month and like pray. Always rebalancing and updating your positions to make sure you have that Delta One, Beta One target. So every day you wake up, you don't have to guess because in the traditional cover call strategy, while there's some very quality managers out there, one day you might have a delta or a beta of 0.67, the next day it might be zero point 0.8, the next day it might be zero point 0.2. Every day is a little bit of a different experience based on where that position is versus the strike that was sold. And it's kind of hard to understand exactly what you're getting. And then looking at performance in the rear view mirror, it's kind of like a random walk and a bit of luck as to how you performed based on what the beta target was of your fund. And I think a lot of people have been looking for derivative income strategies that, yes, it's great to optimize the Sharpe ratio, get better risk adjusted returns, but we want to also match or beat the top line. And so that's what we intend to do here with this lineup, is to have this strategy that can give you that full upside exposure, albeit also with a stronger Sharpe ratio and a better risk adjusted return on each individual leg and then stacked on top of each other.
Nice. Now, before we get into more specific questions, did any of the news from the last 2 weeks affect this in any way? So we got an announcement for a new Fed chairman. The market kind of reacted adversely. Bitcoin tanked, so did gold and silver. Did
Yep.
any of that kind of come unexpected or change anything?
I mean, I think the selection of the new Fed chairman surprised everyone. I think the
Yeah,
reaction by the markets because of that was to be expected, albeit I think it was a little bit overblown. I think everyone expected a very friendly Fed chairman, and what we got is someone who has historically been a little bit more hawkish. I do think the market overreacted a little bit. I do think he will still continue to cut interest rates, just as the expected Fed chairman would have done as well. I think the main difference is the size of the balance sheet. He's going to try to bring down the Fed's balance sheet. And that's great. I think that's very necessary. I think that leads to a healthier market, but let's call spade a spade. That doesn't change the debt outstanding by the US government and the
right.
deficit that the government has on a quarterly basis. We're running near all-time deficits when all assets are also near all-time highs. And, the Fed chairman can only manage the Fed's balance sheet. And so maybe he brings it down from 6 billion down to 4 billion or something like it, or 6 trillion down to 4 trillion, 3 trillion. Like we're, I think we're printing a deficit that's I think about $6 trillion a quarter. So it far surpasses anything that the Fed's balance sheet can do to affect overall debt situations and really the validity of the U.S. dollar holding and stabilizing its value over time. So I think it was a little bit overblown. And then if you take a step back and you look at like what has happened to Bitcoin over the last 6 months, I think the most telling correlation is Japanese 10-year bond yields. So if you look at the Japanese 10-year bond yield, it's gone from like 1.6 up to almost 3%. And that's been the world's cheapest cost of leverage. So as those interest rates increase, people have deleveraged their portfolios, and that's hurt risk assets. That's hurt, the AI trade. That's hurt Nvidia and Microsoft, and that's equally hurt obviously risk assets such as Bitcoin. But if you look at gold in the 2010, there was a lot of people who allocated to gold between 2010 and 2020 on the concept of currency debasement. And there were years where it worked, and there were years when it didn't. And it doesn't mean that they were wrong. It just means that you have to have a little bit of a larger time frame. So I think this fallacy that just because of this 6 month period that Bitcoin is no longer a currency debasement hedge is a little bit overblown and potentially might even create a buying opportunity. Just because 6 months is just way too short of a time period to really look at an asset in the purpose of currency debasement and judge it to be a correct hedge or a decent hedge in currency debasement or an incorrect hedge.
What's interesting, because last week I had one of your peers on, and he pointed out that Bitcoin in its history has dropped 80% or more, I think
Right.
4 or 5 times in the history of it. So this really isn't anything new. Based on dollar amount, it's more extreme, but percentage wise, it's really nothing new.
Yeah, honestly, if anything, gold's drop in the last couple weeks on a standard deviation basis was much larger than Bitcoin. Bitcoin
Yep.
had about a 2 standard deviation move on the downside, whereas gold had upwards of a 6 plus standard deviation moment. Unfortunately, the two happened in very correlated fashion, which we don't like to see. Obviously, we're stacking these two assets and hoping for maximum diversification. We know assets are going to move up. We know assets are going to move down. We hope that they do so in an uncorrelated fashion, especially between Bitcoin and gold in this pair. But again, that's going to happen from time to time. It's not something we expect is going to be the new normal. We still expect this near zero correlation that we've seen between Bitcoin and gold over the last 10 years to hold up, albeit it was just a very volatile period on the downside. But honestly, I think it gave us a lot of opportunity to show, especially in this income stack lineup, whether it's ISSB or ISBG, how much we can really pop on the upside. And seeing how much these things moved on a day like Friday, I was very, very proud of. And I think, a lot of people are truly looking for this growth and income concept in their income vehicles. And I think that's what we've proven to construct here. And you saw that very much so in the movement on Friday. And I know a lot of firms are coming out with higher leverage target single funds. But the concept of leveraging two different funds on top of each other and having that diversification, we think is a much more responsible way to have that leverage. And even funds that have that 1.5x target beta or a target cover call strategy, their beta isn't 1.5. It actually will start out somewhere around 1.35, and then again, since they're not rolling their calls that often, it'll float. One day it'll be 1.4, the next day it'll be 1, the next day it might go down to 0.7, 0.8 and back up. And so every day you're getting a little bit of a different beta to the market, and it's not necessarily on the prowess or expertise of the investment advisor. It's really just on a random walk of the markets. So by being a risk manager first, we think that we're really offering a product that will be able to really capture the upside, compete on the upside with products that are not in the income space, all while still generating that income. We've paid our first 2 weekly distributions. Both funds, we paid 9 cents. If you do the annualized yield on that, it's right around a 18 to 19% yield. We will range in that 18 to 25% range. What we won't do is we won't overpay on drops. Some managers will say, "Oh, there's more volatility in the market, but there's more premium. Here's a bigger payment." We think that's a little bit irrational to overpay on a drawdown in NAV. We want to protect the value of the NAV of these funds. So these are long-term holds in people's portfolios. And so you'll see us even pocket some of that increased premium in times of volatility and wait for a better day to overpay than when the markets have pulled back, to have a better investor experience and have a vehicle that can hopefully compound over time, and also have a dividend that can compound over time, so that you have, in hopes of 3 to 5 years out as a shareholder, a vehicle that its dividend will be higher on a dollar basis in 3 to 5 years than it is today, and not just kind of ever eroding with time. Another big thesis and message we're trying to put out with these new funds, the new income stack lineup, is distribute responsibly. You can only distribute what you generate. So let's say Bitcoin is set to do 10 to 15% in annual returns. Let's say gold is set to do 7 to 10%. Call it somewhere between 17 and 25% between the two. Where does the rest of the value in a fund like this come from? Well, you have to pay for financing. That's 4%, minus 4%. You can probably add 2 to 5% additional returns just from diversifying and rebalancing the two assets. And then you can add maybe 3 to 7% from harvesting the volatility on each leg, as we talked about like last Thursday, where we were moving our tenors around. And when you add that up, you're like, well, actually, you can't really get north of maybe 25, highest maybe 30% returns in a given year. And that's why we're targeting this 18 to 25% returns. And really pushing the message that funds should only distribute what they generate. We don't want to be a manager that says, well, if you wanted a good experience in our fund, you should have just reinvested your dividend. I think people seek these funds to use their dividends as they see fit, whether it's to use it in their daily lives or to choose to use it to rebalance in their portfolio. They don't want to be told a year later from the manager that, like, well, if you wanted a good experience, you reinvest 100% of it, reinvest 40% of it.
Yeah. Then what's the point?
What's the point, right? Like, why
Yeah.
not just distribute less? And honestly, in many cases, they're not distributing less because that very high, fancy distribution rate is what attracted a lot of the initial dollars off the bat. And so we're doing, call it 18 to 25% on a 200% levered basket. And that should tell you how conservative we're being with these distributions to do everything possible to protect that NAV over a long period of time and have an NAV that can even appreciate over time.
I heard an interesting theory. Actually, they basically said it. I guess I'll just be a little controversial, but I mean, the last interview I did with a peer, they said that basically if there's not such high distributions, and this makes sense, it's basically then it's a corporate tax rate for them if they're not distributing everything back to the shareholder.
Yeah.
So
And we're definitely focusing on being a tax efficient vehicle because we intend to have so much upside in these underlying assets. We're using the flex options so that when we roll our beta, it's not a taxable event. And so a lot of the gains that we intend to build up in the fund when, whether it's stocks, Bitcoin, or gold, stocks and Bitcoin will be ISSB, Bitcoin and gold will be ISBG, can be rolled over in a taxable way. And for those that don't fully understand what that means, you can use a concept called a heartbeat trade in ETF, and you can take positions that have big gains in them and not make them taxable events to the shareholders. The premium you generate, that's a taxable event. That's good taxes. That's taxes on premium generated. but just rolling over your beta is not something that you necessarily need to cause a taxable event for. And as I alluded to last Thursday, we moved our tenors. Tenor means like the date at which the options expire, pretty drastically to harvest a lot of that volatility. And unlike a lot of managers that we've seen, a lot of our options, we have the mandate where we can go short as like a zero DTE option to as long as an 18-month option. And that flexibility is where the value add is in being an options manager. There is no one option strategy that's a full panacea. Zero TD did really well 6 months last year. Why did it do well? It did well because everyone expected higher volatility in the future that never was realized. Everyone expected there to be more volatility, and the actual volatility we experienced on a day-to-day basis was actually quite low. If you look at, for example, Bitcoin this year, the exact opposite happened, right? We actually had a ton of realized volatility in Bitcoin this year so far. So if you looked at like a 3-month cover call Bitcoin strategy versus a zero TTE cover call strategy in Bitcoin, the longer dated option did a lot better because that has a little bit more Vega embedded into it. It has a little bit more volatility protection. It's actually long volatility. So we were long volatility going into last Thursday, and we took that opportunity to shorten that volatility hedge. And moving those tenors, we think, is really where the value creation is in a strategy like this, as opposed to just saying just zero DTE or just longer dated options or just 3-month options. Having that flexibility is where we believe that some alpha creation can come from in a fund like this.
Yeah, definitely. Now, can you explain flex options to a novice?
Yeah, flex options are somewhat of a over the counter option that you create with a dealer that mimic traditional options, but are eligible for this heartbeat trade. And heartbeat trade is a very confusing thing, but it's kind of the backbone of the ETF world. I'll explain it first in stocks because I think it's a lot easier. And this is not new. This has been the backbone of the ETF world for decades. You could have Microsoft in your ETF, and maybe it appreciated a couple 100% over the last decade. And you could say, I want to trim this. Instead of just outright selling it, you exchange it and you take those low cost basis shares, you put it on a market maker's desk, and the next day they give you a fresh batch of either the same position, like MicroStrategy, or a similar option as we're using it as, and that no longer has a lowered cost basis. And that market maker, because they're just facilitating trades, they're not actually taxed on those sells. So you put this low cost basis position, you push it onto the market maker's desk, you get a fresh batch of this almost identical exposure, and you have erased your tax liabilities in that position in your fund. It's one of the backbones of the ETF industry. It's one of the reasons why I truly believe that hedge funds really should be launching ETFs as fast as possible, because you have this tax advantage in an ETF wrapper that you just don't have in any other vehicle in the world. Between the liquidity, the ability to redeploy the capital, the tax efficiency, the institutional cost of capital, of leverage, there's just no reason why vast portions of what you see in the hedge fund world shouldn't be done in the ETF wrapper. Albeit instead that they might want to protect their very large fee, and some of them are a little worried to show their holdings or their day-to-day returns or really make their full return stream available to the public. But we're trying to build hedge funds for Main Street. That's really our entire firm's goal, is hedge fund-like offerings for Main Street. We're not doing 60, 80, 100% distributions. We're trying to do realistic distributions that we can actually generate from the returns of the fund, whether it's the returns of the underlying asset class, from the correlation between the two asset classes, or the volatility that we're harvesting off of each individual asset class.
Great. All right, so we got some specific questions now. First,
Please.
regarding the return stacking and the leverage. So what would be your maximum allowable drawdown, and how does your systematic model decide to cut losses before they become permanent capital impairment?
So we will every day offer 100% exposure to both. So we are fully exposed to both. The way we get our beta by using in the money call options, it means that as a position draws down drastically, our exposure draws down as well. So this is a little bit different from a traditional leverage ETF. I don't know if you saw the silver squeeze a couple weeks back, right? What happened there is, like, actually as silver's falling in a 2x silver ETF using futures, the exposure to silver is actually increasing. So all of a sudden, at like halfway through the day, that 2x silver ETF might actually have like a 2.25, 2.3 times silver exposure. So they have to keep selling those futures. That's the exact opposite of what happens here. On the downside, we will actually be lowering our beta, and obviously we'll rebalance to get it back up, but we don't have any stop losses to kind of time out the market or step out of the market in these vehicles. I think it's very hard to time markets, but the two areas where we think we can add consistent value is taking advantage of the diversification of two assets, and one, harvesting the volatility of these options chains. Generally, more times than not, the volatility expected in an options chain is higher than what it'll actually be in realize. So there's real value, there's real mathematical value in harvesting that volatility. But no, this isn't like a market timing strategy where we'll stop out of the asset and get out of it completely and wait to get back in. Because again, you can be right once or twice in that, and then you can be wrong and lose all the gains that you had banked up from being right for years in the past. And as we've seen in the last couple of years, whether it's Liberation Day or heading into this new Fed chairman, the market is usually smarter than you are. So trying to directionally bet on the market is very hard. And just understanding that assets like stocks, the S&P 500, Bitcoin and gold over long periods of time are most likely going to go up. They're kind of designed to go up.
Right.
The dollar is designed to go down. And so we're kind of just structurally taking advantage of that. So this is definitely a leveraged vehicle, but this would be safer than an individual investor taking on margin, for example, of their account. You don't have to worry about getting a margin call. We manage all the difficulties and nuances within this fund, and rotating those tenors and those strikes within this fund, as I mentioned, up to 2 times a day. And three legs of this option. We're long beta, anywhere from 1 day to 18 months. Sell calls on a portion of it, anywhere from 1 day to 6 months. Sometimes sell puts for anywhere between a 0 to 33% of the portfolio between 1 day and 90 days. That gives us a big mandate to add value. Sometimes will look like shorter dated option strategies. Sometimes will look like longer dated option strategies. But that's where the value is. I always like to say, I think there's some managers who will say, oh, zero DT is the panacea. It's the only way to do it. I always phrase it like this. Look, anyone can go into a kitchen and cook, but not everyone is a chef. And at the end of the day, these are tools and ingredients to use in a mixture to make a portfolio. And we'll have rational thoughts on when we will be longer dated and when we will be shorter dated, when we'll have some puts in the portfolio, when we'll have no puts in the portfolio. And if you or your manager that you're allocating to doesn't have a good reasoning to rotate amongst them, you have to ask yourself, is it just really a random walk? Are they just doing one thing? And that's not bad, but that just makes you, the allocator, the portfolio manager who has to rotate. Okay, I have some zero dated option strategies in the S&P 500. I have some 3-month option strategies in the S&P 500. This did better than this. I need to rotate from this to this. The onus is on you to be the portfolio manager there. But we're trying to create true hedge fund-like strategies in ETF where those difficult rebalancing periods, those difficult choices on what your tenor is on your option strategy will be embedded into the fund, because we feel like that's what a true hedge fund-like strategy should offer in this ETF wrapper.
Yeah, definitely. Pivoting back to the Fed chairman discussion. So, do you think that the new Fed chairman's appointment is a policy divergence from what happened on, I think, December 1st, where the Fed essentially started quantitative easing again? Do you think we're going to go back to quantitative tightening now?
I mean, in some essence, we will have a little bit of quantitative tightening. He won't do it to an extent that it will break markets. I think first and foremost, they will try to protect markets and try to protect employment. The first thing that goes when markets start to get rocky is employment.
Right.
And I think I've said this on a couple shows over the last couple months. The Fed was created to fight corporate greed and banking greed. What it really doesn't have the tool set to do is to fight government greed, right?
Yeah.
It just doesn't have the tool set to do that. So it can make small efforts to clean up the balance sheet and have a little bit of quantitative tightening. I don't think it was actually in response to that, because I think initially Trump wanted a very dovish Fed.
Hmm. Right.
But I actually think if you look at how much he was attacking the Federal Reserve, and even Jerome Powell was saying like the solvency of the Federal Reserve is being put into question. I actually think a lot of the Republicans went to Trump and said, "Listen, we cannot have the solvency of the Federal Reserve be put into question. So
Yep.
our response to you is we are not going to give you the Federal Reserve dovish chairman of your choice. This is the guy that we wanted." So I actually think this was the Republicans pushing back on Trump and saying, please, you're doing a great job with markets, but do not mess with the solvency and independence of the Federal Reserve. That's like at the core of our markets and our economy, and it's really important that they truly have their own independence. So I think this was really a pick that allows the markets to see that the U.S. Federal Reserve is truly its own entity and not necessarily politically driven.
Right. Yeah, that actually makes sense. I thought something similar happened because he was very adamant about having someone that was just going to come in and cut rates like every time they met. And then it did seem like there was some kind of pushback that led to this appointment.
Albeit, I do think that he will still cut rates a number of times this year, just because the data will say so, right? I
Hmm.
think he's focusing more on the balance sheet and cleaning up the balance sheet. So it'll be a teeter-totter between lowering the Federal Reserve balance sheet and then also cutting rates. And
Hmm.
so call it like a net neutral, or even more of effect on cutting interest rates that might have an actual greater effect. So I do think some of the moves you've seen were overdrawn. And as I mentioned in the 2x silver ETF, a lot of this was just financial gears in the markets. Like once gold and silver started falling, silver started falling really far, and then like the continued drawdown was in many cases because of assets in some of these 2x 3x leverage ETFs that had to be forced sellers at certain points, not because their mandate said you had to sell, just because the way those portfolios are constructed, when you have future based portfolio that don't have two uncorrelated assets, that they just have one asset, when that asset falls, their exposure increases, so their 2x target intraday becomes 2.2, 2.3. And as that selling intraday occurs, they have to sell more to get back in line with their target. It's not like any
Hmm.
mandate to like cut losses and run. It's just keeping in target. And that's why in BTGD, which we do use futures, we have two futures that can move independently of each other, because you don't have as much of that problem when you have two assets that are moving in opposite directions of each other.
Right. Okay, we had a question about the stock and gold one. Uh, is that one? I know you probably can't give specific dates, but can we expect that one soon?
Yeah, we're definitely. It sounds like that's one that people have a lot of interest in. We've heard
Hmm.
that from the crowd from as well. So I can't give you an exact date, but it is an approved ETF from the SEC, and we will be looking to roll all of these out in due time. So,
Hmm. Great. Yeah, he said he doesn't want Bitcoin exposure at this point.
yep, understood, understood.
Yeah. Okay, let's see. So, in a volatile sideways market, these instruments can experience volatility decay. I know we've touched on this a bit, where
Yeah,
the fund
I'll
underperform. Yeah.
I'll just comment
Go
on that. Like, if both legs go down together, you can have a little bit of volatility decay. But the beauty of these structures are they're intended to have assets that aren't perfectly correlated. So as long as they're not going down massively together, you won't experience that same decay as you see in traditional leverage ETFs. That's
ahead.
the whole concept of this return stacking. We're not the only fund manager doing return stacking. It's one of the fastest growing categories out there.
Yeah. Hmm.
It was started by PIMCO in the mutual fund world in the 90s. PIMCO just launched a stocks and bonds stacked product. BlackRock, JP Morgan all filed for a managed futures and stocks stacked product. This is just a better way to offer leverage ETFs that most of the decay can be removed from the ETF. Not all the decay. We saw a period last week where gold and Bitcoin moved down
Sure.
together, but you remove a lot of that decay, and it becomes a vehicle that you can more safely buy and hold, and you don't have to be an active trader. There's nothing wrong with leverage ETFs. You just have to actively trade them. As they're going up, you have to trim, or else you'll go above your 2x target. As they're going down, you have to add, or else you'll go below your 2x target. And that's very hard for individual investors to do in the face of volatility, whether it be Liberation Day or even a day like last week when both Bitcoin and gold are falling. It's hard. It's a very emotional trade, And it's not magic. We're just taking that emotional trade and doing it unemotionally embedded within these ETFs and teeter-tottering between the two. And so that example I gave you on 2x silver, if the assets in our leverage ETF, BTGD, that is using futures, move in opposite directions, we don't have that problem. Occasionally they'll both move down and then there is some decay. And occasionally they'll both move up and that decay actually works in your benefit. But more times than not, they're going to move in opposite directions. And that's the value of this whole concept of portable alpha or return stacking.
So these could be suitable for a long-term investor.
Yeah, I mean, you still need to understand that you are taking on some leverage, and we basically hope to offer you the return of one plus the return of the other, but not the risk of one plus the return of the risk of the other. And that's because we will be rebalancing between the two. But as long as if you're using leverage responsibly, and by responsible I mean every big institution, every big hedge fund endowment uses a little bit of leverage. That doesn't mean they full port equities and they have 150% exposure to equities, right? That means they're using different asset classes to get to a total portfolio that might have 110 exposure, 120% exposure, 130, 40% exposure, but to different assets that move independently. And then the next most important thing is rebalancing, doing those difficult rebalances. So this embeds that leverage in your portfolio and also embeds that rebalancing in your portfolio. So you don't always have to worry about doing those very difficult rebalances on your own. And you can trust us as a manager to do those rebalances within these vehicles. Again, both ISSB and ISBG or our original ETF BTGD.
Right. Now, how would things be handled in terms of like if there was like a flash crash or like a black swan event?
Well, that's where that embedded put that we have by getting most of our beta from just a long call comes in. Again, we're not going to like sell out of the market and get out of these assets completely, but we will have a little bit more of a muted downside. And that's where, honestly, if you look at last Thursday, ISBG outperformed BTGD because of that embedded put on the Bitcoin side. It added a little bit of breaks. And what that means, it just means you lose a little bit less on the downside and it's easier to compound and grow out of on the upside. And again, unlike some of our competitors you've seen in this space, we do intend to have a lot of upside exposure, offer that 100% exposure also on the upside, and that is uncapped. We are not capping that exposure. We'll continue to have that 100% upside exposure, and we'll rebalance the portfolio as needed, even twice a day to make sure that we hit as close as possible to that 100% exposure on the upside.
Great. And I think I've asked you this before, but do you plan any like market like leveraged funds on like overall market indexes, say like NASDAQ or S&P?
Well, we do have the S&P 500 in ISSB. So
Yeah.
ISSB stacks the S&P 500 in Bitcoin. I've been in the ETF industry for over 20 years. And my white list of fun products we want to launch is endless. I do think there's enough products that just do the S&P 500. I think the NASDAQ is a great index. I don't know if it necessarily differentiates enough from the S&P 500 for us to want to do, for example, like NASDAQ and Bitcoin, et cetera. We think there's a heavy overlap there. And also NASDAQ tends to be slightly more correlated to an asset like Bitcoin than the S&P 500. But honestly, the market decides what's the products they want. So our emails are open. My email is david@quantifyfunds.com. Our overall firm email is info@quantifyfunds.com. Like, we want to hear from you. Like, we've definitely heard a lot from the crowd that the stocks and gold one is definitely of interest. So when we do launch the third one, that is most likely going to be that next one in the lineup. But you guys tell us what you guys are interested in seeing the most, and we'll create products that we think we can add some value in and also make sense for what you guys are looking for. And again, our biggest message here is risk manager instead of strike seller, and distribute responsibly. Like, distribute at a rate at which you think you can actually maintain or grow. And so you don't have to come back 2 years later and be like, oh, but if you had just reinvested 100% or reinvested 50%, you'd be okay. Like, I don't think that's really what the intention here is. You guys want to be able to do with your distributions what you want. Some may choose to reinvest, some may choose to reinvest in other assets, and some may choose to use it to live off of. And that's what these are intended to do. We're intended to set distribution rates that we can actually maintain and not need reinvestment to be able to protect the value of our NAV. Doesn't mean we're not going to have volatility. We're 200% exposure ETFs. Definitely going to have a lot of short-term volatility, but in the longer picture, in 3 months, 6 months, 9 months, 1 year, 3 year, these assets are all expected to go up over time. It's not magic. It's just the way markets are actually designed.
Right.
And so even on a drawdown, you should be able to rebound just from the NAV of these funds alone.
So an investor could actually live on dividends on these funds.
Dividend in the short run, our dividends will fluctuate if we see an extended drawdown. But
Yeah.
over long periods of times, yeah, like our goal is in 3 years, we paid 9 cents our first 2 weeks.
Right.
Our goal is in 3 years from now, 5 years from now, we don't want to pay 9 cents. We want to pay above 9 cents. We want to
Right.
pay 9 cents plus the pace of inflation. Now, if there's a huge market drawdown, the S&P drops down 50% in the interim, will we cut our dividend a little bit to protect our NAV from there? Sure. But, over the long run, the goal is to have higher dividends per share in 3 to 5 years than we have now. And I don't think there's a lot of funds that are really focusing on just that. And, so I would say I wouldn't replace your entire paycheck with our funds because they are
Right.
leveraged vehicles. But to supplement some of your income, I think these are very good vehicles to supplement some of your income. And we really truly strive to have higher dividend payments years from now than we have today. And I think that's one of the defining messages of our firm. That, and again, one option strategy is not a panacea. Just doing 1 year options is not a panacea. Just doing 3 month options is not a panacea. Just doing zero DTE options is just a panacea. Guess what? Last year was a really good environment for zero DTE. So if you're comparing a 3 month option strategy to zero DTE and you look at it last year, the zero DTE manager is going to look good. And then this year in Bitcoin, the longer dated options is going to look good. What we think you guys should consider is to look beyond just 1 year returns and say, well, I actually want a manager that will fluctuate those tenors and make those decisions for me. Unless, like, if you feel informed enough to make those decisions yourself, like, by all means, there's many really good strategies and products out there that allow you to make that very specific trade. But if you don't have a good reason to say why zero DTE should differ from a 3 month or 12 month options strategy, choose an allocator or a manager that will make those decisions for you, because you have to get really in depth. And Tom, I know you know the options markets very well, and Greeks, etc., and you're very well equipped to make some of these decisions. But I think you'll agree that there's no one strategy that's a panacea above others. They're just all applicable for different markets.
Yep.
Longer dated options actually have some volatility hedges built into them, because if volatility spikes, the price of those options spike. That doesn't happen in zero DT options. So last year was a year where everyone expected volatility behind the future, and then the realized volatility that we experienced on a day-to-day basis was low. So owning that hedge, owning the volatility hedge in the longer dated options, it was not a benefit to your portfolio. Not owning it
Right.
and having zero TTE in a world where we had very little expected volatility was actually very, very beneficial. And what we're trying to provide here is strategies that will make those very tough decisions for you. Unemotional, just like last Thursday, Bitcoin volatility spiked. Either Bitcoin was going to bounce back like we saw on Friday or completely implode. That's what the
Yep.
volatility chain was showing.
Yep.
And we bet that was wrong. So instead of betting on the direction of Bitcoin, we're betting on the volatility of Bitcoin going down. And that's a much easier bet to make than trying to make short-term bets on the direction of these assets.
True. Yeah, there were even articles coming out saying Bitcoin's going to zero.
Yeah, absolutely.
Yeah. All right, so we've got some more feedback here. So he says, if you guys came out with a semiconductor gold silver stack product, I would back up the truck to buy shares.
Is that was Andre? Andre, thank you. We will definitely add
Yeah.
that to the drawing board. I do think that what you said, semiconductor and gold, yeah, gold and silver stack, yeah. I do. I will say a lot of people will ask me why we chose gold and not a broader basket of precious metals. I think what we saw over the last couple weeks in silver is very telling. Silver has had three massive spikes over the last like 40 years, And I still think silver is actually a very good investment long term, but it's much more volatile. So one of the things you do want to be careful of, especially if you have a leverage ETF, is choosing assets that aren't the most extreme volatile versions of each asset. And when we look at gold, what it differentiates gold in our eyes from silver is that its value primarily, almost entirely, comes from its scarcity profile.
Yep.
Silver is used in AI chips and our phones, and that can be very beneficial when the economy is growing. That also ties it a lot more to GDP growth. That ties it a lot more to the S&P 500. That ties it a lot more to semiconductors specifically. And so again, doesn't mean both of them shouldn't be in your portfolio, but just be cognizant that they both have this underlying risk of, for example, if there's a period of underperformance in AI for a quarterly basis, it's going to impact silver a lot more than it'll impact gold. And I think we've seen that over the last couple of weeks with AI stocks faltering a little bit, technology stocks in general faltering a little bit, and it affecting silver much more than it affected gold. But I'll definitely add that to the drawing board. Please, we love all these ideas. Email me directly, david@quantifyfunds.com. We'll keep the whitelist going here. So
Yeah, he was hoping for like, do you have an idea on the ISSG? I know you can't give a specific date, obviously, but he keeps following up on.
I think we'll come back with a better expectation in the next couple weeks.
Mhm.
But we've definitely heard a lot of that.
Yeah. Now, as far as AI, do you expect this to still be a really solid year for AI?
Gosh, I think it's really hard to predict what these companies are going to do in the very short run. I think it depends on what part of the AI market you're looking at. I think the Mag 7 stocks. I think a lot of people look at their concentration and worry about them and how concentrated they are within the S&P 500. I think it was actually Eric Balchunas of Bloomberg that said this. These are more economies within stocks than they are single stocks. Our concentrated stocks of the past in the 2000s, they were companies that did one thing. Like, what does Google do? Google has 50 business lines. Amazon has 50 business lines. These are
Hmm.
full economies within them. What we've seen as of late is some of these SaaS companies have really been hit. And so I think that's almost the yin to the yang of the AI trade. A lot of these SaaS companies, I think it was Salesforce, was trading at a 30 times multiple, meaning people were happy to pay 30 times 1 year profit for it. And it fell from 30 to 15. And I think that's the yin to the yang of AI that a lot of people are betting. A lot of these, like whether it's Claude from Anthropic or Gemini or Grok or ChatGPT, that a lot of companies would be able to build out some of these processes in-house, and a lot of these SaaS companies can't be depended on for their revenues for decades to come. Look, I think the AI trade is going to continue to grow our economy, and I think what you're seeing now is a healthy shift to it growing in other areas of the markets, other sectors. If you look at a sector like industrials or utilities, these are sectors with thin margins, like razor thin margins. If AI
Yep.
moves the needle in them a little bit, they make those sectors so much more profitable. So I think what we're seeing is just kind of rotation in the markets of how AI is affecting markets. But no, I don't think the AI trade is done. I just think it's evolving, and you're seeing a rotation into not just the producers of AI, but who are the benefiters of AI and who are actually applying all this amazing technology into their business to just ever so slightly increase their margins.
Hmm. Now, regarding your two newest funds, so how do the options overlays on both affect performance during rapid market rallies? And is there a cap on the Bitcoin-driven upside potential?
No cap, and that's what's most unique about what we're doing here.
Yep.
If you take a basic cover call strategy, like in a lot of these products feel very much like an index product. You own the S&P and you write calls in the S&P 500. You now actually have about like 2/3 exposure to the S&P 500. When the S&P moves up 10%, you're going to move up about 6.5%, right? There's nothing wrong with that construction. You're going to have a higher risk-adjusted return. You're just not going to outperform on top-line returns as well. That's exactly what we designed to not happen in these funds. The total return basis of these funds is intended to still outperform the underlying. So we'll be long a call, short a put. that combination, that three-leg combination, will still have 100% exposure to the market. Unlike a traditional cover call, once you sell the call, you have 2/3 exposure. Our entire option legs, once they're constructed, is designed to still have 100% exposure. There are a couple other firms that are doing that. They call it Delta One products or Beta One products. So we are Delta One, Beta One products on each leg. And then the thing we're doing beyond what some of those other strategists are doing is we're also changing the tenor, whether it's short dated options, long dated options. But irregardless, whether we're short dated options, long dated options, whether we sell a little bit more calls on the upside, whether we buy puts or we don't buy puts, the whole combination is meant to be a Delta One product. So you will still have 100% upside. And I think looking at both ISSB and ISBG's returns on Friday last week, when you saw both Bitcoin and gold roar back, those were up over 10% each in one
Right.
day. And so those clearly show the uncapped nature of the upside of these vehicles, which means we intend to be cover call strategies that don't just offer risk-adjusted outperformance, that also offer top-line outperformance, also with risk-adjusted outperformance.
Yeah. So last question. So regarding the split from title, do you expect the same scalability and
Yeah,
overall?
so I want to be clear. These are
Yeah.
still done on Title's Trust.
Yeah.
We are just using our own options team, right?
Right.
We're using Convexitas as our options team.
Yes. Hmm.
So Title is still the back office here. So they're still doing a lot of the blocking and tackling on the legal and paperwork side. I
Yep.
just wanted to bring a different options team to the table. So we are very excited to partner with Convexitas, true institutional quality management here. Both Zed and Devin have spent time in the institutional world. Zed at one of the most respected options hedge fund companies, and before his hedge fund days, Zed was tasked with doing options overlays on pension funds. So 5, 10, 15, $50 billion pension funds would hire Zed and his company to do overlays on their entire pension strategy. Convexitas has some SMAs that require 14 rebalancing periods a day. That's the level of specificity and complexity that they're able to maneuver and work within. And that's why I felt so confident and happy to partner with them in this construction. So it's not a full split from Title. Title is
Right.
still the advisor and trust counsel on these products. We just wanted to use a slightly different approach in the option strategy than what we had at our fingertips at Title.
Yeah, no, I think that's a great move. I remember speaking with Zed on a panel and definitely very smart. And
Yeah.
yeah, I think that's the options are in good hands for
Yeah.
sure. Yep. Well, that's going to wrap it up for today. Thanks so much for coming back on. I think we got to all the questions. And any last comments for the audience?
Just wanted to say I appreciate you, Tom. I appreciate you for doing these long form formats.
Yep.
These truly are, as you guys have heard here, hedge funds and ETFs. They're complex. They move. They're going to rotate and still offer that same exposure. They're not strategies that you can just pitch in 15 seconds. So it's because of people like you and platforms such as yours that give us the opportunity to truly explain what we're doing here. So just want to say I'm grateful to you and your audience for listening in, and thanks for your time.
Absolutely. And thanks for coming out with great funds.
Of course, thank you.
Yeah. Uh-huh. All right. So for the audience that's on, please remember to like, comment, and subscribe, and join Discord and check out Quantify Funds. And David?